India's GDP growth came in at 8.2% for the quarter ended September 2025. Took a lot of people by surprise because the consensus estimates were lower. Why did this happen? And what do inflation and the GDP deflator have to do with this? Let's take a look. Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. GDP is typically derived from sectors categorized into three, typically primary, secondary, and tertiary. The primary sector is one in which there is resource extraction, such as in agriculture. The secondary sector includes those such as manufacturing and construction. And tertiary brings in sectors such as finance and banking and so on. India's GDP growth for the quarter ended September was spurred by the secondary and tertiary sectors, which came in at 8.1 and 9.2% respectively in terms of growth. Let's look at the specifics. Manufacturing at 9.1% and construction at 7.2% registered healthy growth rates. Financial, real estate and professional services also saw robust growth at 10.2%. Agriculture and related services at 3.5%, and electricity, gas, water supply and other utility services at 4.4% saw moderate growth. Real private final consumption expenditure grew 7.9%. This compares with 6.4% in the same quarter a year ago. If this growth momentum sustains, it's actually a healthy thing for the economy. This would be indicative of increasing demand. And when private demand increases, companies in the private sector would start expanding their investments, including in private capital expenditure. When that happens, it would allow the government to move funds away from public capex into other important areas such as public healthcare and public education. Again, as we said, if this growth momentum sustains, then it's actually a healthy sign because already there is potential for revenue collections by the government to start dipping in the coming months, given the benefits that it has extended to taxpayers on the income tax and GST fronts, allowing for lower payments. In a report earlier this week, Goldman Sachs said that it expected the government, the central government in India, to meet its fiscal deficit targets for this current financial year by reducing public capex to offset potential shortfalls that it could anticipate on the income tax and GST fronts. The report highlighted that central government capex contracted sharply in October, declining by about 28% year on year. This fall was mainly due to lower capex transfers to states, even as defense capital expenditure continued to remain strong. Now, more often than not, there is a difference between nominal GDP growth and real GDP growth.
Watch the full video at the Hindu Originals.